I can't believe the big banks are going to do this, and you're going to be outraged when you find out too. I'm your host, Steven Van Metre, and thanks for joining me today. And with the Fed set to raise interest rates in their March meeting, many are hoping this will lead to higher rates on their deposits. But the banks, well, they have other plans. Let's head over to the Wall Street Journal, who kicks off the story by saying, don't expect rising interest rates to boost your savings accounts, as banks are unlikely to pay depositors more after the Fed first lift rates because the lenders, well, they don't need the money. The Federal Reserve has signaled it will raise rates in March, the first in what is expected to be a series of increases this year. And higher rates normally mean bank customers stand to make more on their deposits, but not so this time. Banks have little incentive to raise the interest they pay on deposits because they simply don't need the money. Government stimulus plumped up American bank account balances, and companies are flush with cash. Total deposits at U.S. commercial banks have swelled to about $18.1 trillion, up from $13.3 trillion at the start of 2020. And you know what? They're right. The banks are flush with cash. Check this out. We'll head over to the Federal Reserve, St. Louis Federal Reserve database, where we can see $8.06 trillion sitting in deposits. Well, and that means the banks, well, they're absolutely flush with cash. Banks, which pocket the difference between what they charge borrowers and what they pay depositors, and what are expected to use the opportunity to breathe life into their bread and butter lending business. Profit margins from lending fell to new lows across the banking industry after the Fed cut rates to near zero in March 2020 during the onset of the COVID-19 pandemic. And here you can see that the problem with bank lending actually went back to the great financial crisis. And oddly enough, as we'll show you in a moment, started with something called quantitative easing 1, which doesn't seem to work well for the banks. But check this out. Here we are back at the Federal Reserve database, and you'll notice that in 2008, loans and leases in all commercial banks, that while they briefly rose, they actually went down during the great financial crisis and the year after, as we were doing quantitative easing. And you'll notice the trend line, as I crudely drew here in red, is well above what actually happened. And notice as we return to quantitative easing world, what happened? Well, loans and leases stagnated, and we're not even back to the former highs, sitting at, again, $10.7 trillion, or a little over a $7 trillion difference. So keep that number in mind as we continue with the story of why banks don't need your money. All right, let's go on, because the average rate on savings account at the largest U.S. bank stood roughly at 0.06% at the end of last year, according to Bankrate.com, leaving many wondering, why is it so low? And many high-yield savings account, which offered 1.5% or more before rates headed towards zero in early 2020, now offer rates around 0.5%. And here's why your bank account isn't paying much interest, because if you look at what's called the IOER, interest rate on reserve balances, this is the rate that the Fed pays the banks on those quantitative easing created reserve assets. Well, they're paying them 15 basis points, or 0.15%, meaning you're getting 0.06, the banks are getting 0.09, and that's why you're not going to see rates start to rise, because the Fed has got a floor on this. And check this out. On fourth quarter earnings call last month, bank executives said those rates aren't likely to move in tandem with the Fed increases this time around. And why is that? Well, because the banks don't believe the Fed is going to raise rates on that IOER number. And if they do, it won't be that much to offset what the expected increase in the federal funds rate could be, which is estimated to be anywhere from 0.25 to 0.5% in March, which we'll soon see. Let's continue on with the story, because for deposit rates to rise, banks need to make more loans. And low rates coupled with lackluster demand from borrowers for much of the pandemic put deposits and loans out of whack. But that's starting to shift as banks reported higher loan demand the last 3 months of 2021, and most expect that trend to continue in 2022. And here you can see the difference between deposits and loans and leases at all commercial banks. Well, there's your roughly $7 trillion gap, and you can see up until the great financial crisis, they were linked together. And after quantitative easing 1, well, that picture has permanently changed. And so you're not going to see deposit rates jump with any sort of magnitude until banks have many more loans on the books than they do today. And rising rates might nudge some deposit customers to move a chunk of their money into higher yielding investments, and that could prompt some banks to raise deposit rates. And if you're concerned about what you're earning on your cash, well, maybe you should check out Portfolio Shield. It's got a great conservative model that many people use for that. There's a link in the corner and in the description below. Let's continue on with the story, because you can see now when we take these reserve assets, these byproducts of quantitative easing, which stand at $4.2 trillion. And here you can see in the chart that before QE 1, 2, and 3, they're effectively at zero. And now these are those reserve assets, again, created by quantitative easing by the Fed. And why did they do this? Well, they did it to help fill in some of that gap from loans and leases and deposits, to give banks some interest to pay on those deposits. And that's what a lot of people don't understand. The banks just didn't have the assets to back all these deposits. So what did the Fed do? Is it created assets for the banks to use, and it forced the banks to buy them. But what is the problem with that? Well, there's still a $3 trillion shortfall between the two. And what that means is either the banks would love to shed $3 trillion in deposits, or they need to get their loans and leases up by $3 trillion just to bring things back to parity. And until either of those two things happen, well, don't expect deposit rates to rise at all. And with that, we'll wrap up today's show. Thanks for being fans. Thanks for watching. And now you know why the deposit rates on your account are probably not going up. I'm Steve Van Metre. Bye now. The content of this video is provides educational information only. It's not intended to provide investment advice. It is not to be construed as recognition or solicitation, buyer selling security, financial instrument, or participate in any particular trading strategy. This video is prepared by Steve Van Metre. Personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.